Welcome to today's webinar entitled Cooking with Mikey, Making Investment Salsa. Thank you for listening today. My name is Mike Wilson, one of the retirement planning advisors here at Utah Retirement Systems, and our guest speaker today is Michael Coakley. And this is, or just a couple notes as we get started, this is actually a re-recording of the actual webinar that we ran because we had some technical difficulties, which really means I simply forgot to push the record button. But Mike has graciously agreed to re-record the webinar, and so that's what we have today. So if you weren't able to attend or listen the first time around, good news, Mike's going to run through making investment salsa again with us today. And if you didn't hear from the first time, a little bit on Mike's background, he attended the Wasatch County School of Culinary Arts. Okay, not really, that was kind of made up, but it seemed to fit the investment salsa thing. He actually attended Fresno State. He's been in the financial service industry now for over 6 years, and he's currently working on his Certified Financial Planner designation. So Mike knows what he's talking about. It's kind of the bottom line. And with that, I will turn the time over to Mike, and he will take us through today's webinar.
Mike, thank you so very much. It's a pleasure to be with all of you here again today. We are cooking with Mikey. We are making salsa, and it's the best kind of salsa. We're making investment salsa. So today, during a lunch hour, we're going to kind of preach and teach about how to mix up the best kind of ingredients to get the best salsa for you regarding your investment options here at Utah Retirement Systems. Let's get rolling, shall we? So, investment salsa, there's ingredients to all salsa, right? There's tomatoes, we have onions, we have lime, a little of that, a little bit of this, there's some jalapenos there. And if you had a bowl of tomatoes by yourself, you'd think that might be a little bland and boring. That's not the kind of salsa that I want to have. But what if someone offered me a bowl of jalapenos? Well, I'd probably refuse that as well, right? A little too spicy for my taste. But when we put all of our ingredients together and have the proper mix, salsa can be a pretty special thing. And it's the lunch hour right now, so I know I'm hungry. I'm sure you are too. So let's get into our investment salsa. On the screen, you have our 8 different core investment options here at Utah Retirement Systems. We have the mild salsa on the left side. We have the medium ingredients in the middle, and as we move to the right side of the page, we're getting spicier and spicier. And so let's go through and look at each of these core investment options. Now, these are mutual funds. What is a mutual fund? A mutual fund is a fund that is investing in many different companies, government entities, different things. And it's great to be able to invest your money not just in one entity or company, but a whole bunch of them. Some of these funds have hundreds or even thousands of bits and pieces of different corporations. So we're getting a good mix of things. But let's just move from left to right and discuss what each of these investment options at URS are doing and what they're trying to do. So let's start with our mild ingredients. We have our income and bond funds on the left side of our page, and those are full of investment grade bonds on the income fund and U.S. denominated government bonds over there in the bond fund. These are more of your bland, mild, okay? They're the tomatoes of our salsa. And so as you can see, there's a brief description right under the name of the fund. We have the investment manager listed there. We have a brief little sample of the portfolio. And then I think the most important part of these investment funds here, it shows in the colorful part the actual returns, the historical growth from last year, the average over 3, 5, 10, and 15 years as well, just so you can see what the actual performance has been. Now I have to stop you right there. As many of us know, when it comes to investing, we cannot guarantee any future performance based on past performance. However, it does give you a good indicator of what has happened in the past. Now below those actual figures of growth there, we have the individualized years over the last 10 years, the ups and downs, the volatility of each of our funds. So if we start with our income fund, you see there's some modest growth there, just a little bit of uptick on the upside there. But then below that, there's not much decline. There's not much loss. And so that is what we're attempting to do in the income fund. We're going to try to get a little bit of growth there without risking too much of your money. And so therein lies, those are the bland tomatoes, right? That's the mild stuff. As we move to our bond fund, this is again a conservative approach. We're investing in bonds. We can see a little bit more volatility here. There's a little bit more spikes in the growth, and we also see a little bit of a decline in a year there. So again, when it comes to investments, when we have risk involved, that has a direct relationship with the reward that you might be getting. So when there is a limited amount of risk, the reward is typically limited, as is with the income in the bond fund. And then as we move to the right side of our page here, when there is more risk involved, there's potential for more growth and more increase. So we've talked about the bland stuff, the tomatoes, those are bonds. Let's move into the funds that incorporate some stocks. Now, stocks are what make the economy have a little volatility to it, right? The ups and downs. So if we talk about stocks, we're talking about being a little bit more aggressive than just the income or the bond fund. So the balanced fund is our first fund that has some stock in it. And the balanced fund is actually just 3 separate core funds put together. And you see there on the portfolio structure, it is 40% in our bond fund, 30% of your money would go into our growth fund, and another 30% would go into our value fund. So that's a balanced fund, right? You're getting a little bit of a mix. You get a little bit of the bond features, and you also get some of the stock stuff there. And it's all incorporated into one fund that we call the balanced fund. Now, moving into just the stock funds, we have our large cap stock value fund, our large cap stock index fund, and our large cap stock growth fund. They all have large cap stock written on them, right? Now, what is large cap stock? Well, that cap stands for capitalization. And that's a measure of maybe the size of a company that we're investing in. So capitalization is basically the price of the share of the stock multiplied by how many outstanding shares are available. And so obviously the more shares and the higher the price, the larger that company is going to be. And so the large cap stocks are the biggest companies in our economy, and there are many companies that we've all heard of. Companies such as Bank of America, Charles Schwab, Apple, ExxonMobil, Amazon, Facebook, Visa. These are companies and products that we know, that we hear about all the time. And so these bring us to the large cap stock. So our first large cap stock fund is our value fund. Now we're trying to invest in funds that we think might be currently undervalued. And so we're going to try to take advantage of that to have the growth and appreciation in our favor. As we move to the index fund, we're investing in companies or stocks that are alongside the Russell 1000 index. And that index is basically a measurement, a benchmark of the stock market. And so the portfolio there is going to be comprised of companies that are on that specific Russell index. And finally, we have our growth fund. Now, this is going to emphasize capital appreciation. We're trying to identify companies that we think are going to have some great future earnings and returns. Hence, we call it the growth fund. Okay, so those last 3 funds are the large cap company. Those are the really, really big companies. And you can see the volatility. There's a lot of spikes, right? There's a lot of up, there's a lot of downs there. There's more volatility because we are investing in stocks there. If we move to our final 2 funds on the right side of the page, we have our international fund and our small cap stock fund. The international fund is obviously investing in companies, corporations that are outside of the United States. So there's some developed and emerging markets that we are investing in. And we are also following an index for that. But those are specifically for corporations that are not here in the United States. And so, for example, we have Toyota Motor Corp there, Nestle, and a few other holdings that I'm sure you've heard of. And finally, our small cap stock fund. If the large cap stock are all the really, really big companies, then you guessed it, the small cap stock is going to be the smaller portion of the portfolio there. So these companies are within the 10% of the smallest part of the New York Stock Exchange and NASDAQ. So these are still very, very large companies, don't get me wrong. They're companies that we heard of, such as Jack in the Box, but these companies are relatively smaller compared to the gigantic Apples and Facebooks. And when you have a smaller company, there's sometimes big opportunities for volatility, and so there can be big swings, and you can see that there's huge growth potential there, but also some pretty big losses. So what I want you to take out of this investment option snapshot here is we have lots of different ingredients here at Utah Retirement Systems. And we're trying to hit each part of our salsa. We have the bland stuff on the left side of our page. And as we move to the right side of the page, we're getting spicier. We're throwing in the peppers. We're throwing in the jalapenos. We're trying to get that mix involved as well. Okay. So let's move on to our next slide. We're going to talk a little bit about diversity. Now, I'm sure that many of us have heard the word diversity or diversification when it comes to investments. What is diversity? Well, it's salsa, right? We're mixing up different ingredients to try to find the proper mix. Now, we do the same thing here at Utah Retirement Systems with our core funds. We're trying to find the appropriate mix, and that's how we come up with target date funds, and we'll talk about that in just a moment. But let's take a look at this slide first. I want you to review the information here and let me know what you think. On the left side of the page, we have the name of each of our core funds. And as we move to the right side, we have each year listed from 2007 through 2016. And finally, we have a 10-year average there. So what this slide is showing us is the growth or loss for each one of our funds on an individualized year. And then we're taking a 10-year average just so you can see how these funds have actually performed over the last 10 years. Now it's color coded, but I want to make sure we're not just reading from left to right. If you're like me, that's exactly what you did the first time you saw this chart. But let's take a look at the income fund. So again, this is our most conservative fund. So it's going to be in pink there. And so each of the pink squares, that's our income fund, and that's the return for each of the years. So in 2007, there's a 5% return, 2008, 4.7, and all the way down, we move down the page. On the 10-year average for the income fund, we're at 2.5%. So if you invested in the income fund, your average return over 10 years was 2.5%. Now, if we look at the international fund, this fund is supposed to be a little more risky. So there's, again, a potential for growth, a reward. But there's also potential for loss. So we see in the green, the first year we had an 8.9% return. The next year, 2008, lost 41%. The following year, it crept back up by 29.5% roughly. But over the 10-year average, it was just north of zero. We're at 0.1% for an average return over 10 years. I don't know about you, but I don't want to have a 0.1% growth. So why do we want to diversify? Well, it's really difficult to know exactly what's going to happen and to try to time the market, right? So it's difficult for us to pick out one of these funds and say, hey, this year this one's going to be great, and this other one's going to be great the next year. So we want to diversify. We want you to have a little bit of each of these funds so you're not stuck with all your money in, say, the international fund, where over 10 years you got a 0.1% growth factor. And we don't want you to have to risk everything and just put it in one fund with 1 year being good and maybe another year not being so good. So we want to diversify. And that brings me to our next slide, which is our target date funds. Now, this is the off-the-shelf salsa. This is where Utah Retirement Systems is mixing up the salsa for you, and we're doing that based on a few different factors. Number one, we're trying to determine when you are going to turn age 65 and or when you are going to retire and start drawing the funds out of your investment accounts. Hence, we have the names of our funds at the top of our sheet here as target date 2060, all the way down to target date 2010 and target date retired as we move from left to right. So we have our titles of our different target date funds in 5-year increments. And again, these years are supposed to represent when you are going to turn 65 or when you're going to retire and start drawing funds out of your investments. Okay, let's go over this chart and discuss what it actually means and how we break it down. On the very left side of our page, you'll see there's 3 different colors. We have blue, gold, and green. In the blue, we've organized the stock holdings for you just so you can see in a different color. The blue's up top, and those are our stock funds. As we move down all the way to the bottom, we have our bonds in the green. So that helps us just differentiate that. On the top, we have our stocks, more volatility, more aggression. On the bottom, we have our bonds, a little more stable, a little more conservative approach. And then the nice thing about target date funds is you get a little bit of extra. We have our real assets right in the middle in the gold. Those involve commodities, which are like bulk goods, maybe oil, corn, whatever, some kind of tangible product, along with some real estate. And again, this just brings us a little bit more diversification with our investments. We're reducing our risk amongst different funds, and we're allocating your money in a few different places. And so when you invest in a target date fund, you get to automatically enjoy some extra commodity and private real estate and real estate investment trusts. Okay, so we have a whole bunch of percentages here in our chart. So let's pick out a certain target date fund and break it down. Let's say that I was going to retire and start drawing my funds out on the year or near the year of 2035. Well, I'd want to invest my money in the target date 2035 fund, right? And all I'd have to do is log into URS, pick my fund for my account, and then Utah Retirement Systems will break down those percentages for me. So they're going to do all the heavy lifting there. If I said put all my money in the target date 2035 fund, then URS would put 7% of my dollars in our large cap stock value fund. We'd put 23% of my money in the large cap stock index fund, another 7% in the growth fund, and so on. We're going to fill up your money all the way to the different funds and diversify it out for you. Now that's fantastic. I didn't have to do all the reading and research to find out what's going to be the best fund for me and research the emerging markets of the world. URS was helping me do that for me. So that's fantastic. And so that's how I pick my target date fund. However, I don't just want to stay at that same allocation forever, do I? If I'm going to retire in the year 2035, then I might be somewhere, I don't know, in my 40s, I would guess. And so if I'm somewhere in my 40s, that might be a great allocation for my money right now, but it's definitely not going to be an appropriate investment allocation for me in 15, 20, or 30, 40 years from now, right? So another great part about our target date funds is we rebalance, we reallocate your money periodically for you. And that's exactly what this little flow chart is showing you. So we still have the same target date funds listed at the very top of our screen from 2060 all the way down to 2010 and retired. You see there's a lot of blue there. There's a lot of stocks for our younger target date funds. And then as we age, the older target date funds are for those folks who are nearing retirement or are in retirement. There's a lot less blue, a lot less stock exposure, a lot more green. There's more bonds, more stability. We're trying to preserve your capital now. You and or your employer have been saving a lot of money in your accounts throughout your career, and we don't want you to have a larger loss right before retirement or in retirement. So we want to transition your funds from being more aggressive when you are younger and in the middle of your career to being a little more conservative right before you retire and then in retirement. So we're going to be moving funds from the stock funds and put them into the bond positions. And that's what this flow chart is showing you. So if I'm in the target date 2035 fund, for my example, each year, Utah Retirement Systems is going to be changing the target as far as my percentages in each of those funds. And we're going to get slightly more conservative yearly. And then there's going to be a jump every 5 years where we're going to add a new target date fund, merge the 2010 fund into the target date retired fund, and then each target date fund is just going to move one to the right. And that's going to be the percentages that we target now for that target date fund. Okay, so we're investing in the right target date fund for us now. It's great. We get to put a lot of money in. Hopefully it's going to grow. And then Utah Retirement Systems is going to handle allocating our money into each of the funds for you and other people who are in your like situation. And then more importantly, we're going to rebalance that fund for you and change the allocation periodically so we don't get you in the wrong fund 15, 20, 30 years from now. So the target date funds are off-the-shelf salsa, can be fantastic because we have a great mix of salsa for you. And it's not just for you, it's for most people like you that are going to retire the same time frame as you or possibly have the same risk tolerance as you as well. Excuse me. So there's another important thing I want to discuss when it comes to investments. It's called staying the course. Now, many of us have experienced the ups and downs of the stock market over our careers. The most recent big downturn was when? 2008, 2009, right? The great US recession where everyone complains, they lost all of our money, whether we're here or there. Well, there's a trend that I see here from the Dow Jones Industrial Average from 1986 through 2016. There are definitely ups and downs, but by looking at this chart, it looks like the market is going up. Now, again, we cannot guarantee performance, but if you stay the course, historically over time, market returns have been positive and they go up. So for all of us who, quote unquote, lost money in 2008 and 2009, you'll see that the market recovered. It not only recovered to where it was before that hit, but it also went up and up and up, and you can see where it is as of last year. And if you're following the market today, the market is going up. There's always going to be corrections in the market, but historically the market catches up after these downturns and typically rises above where it was before. So we want to stay the course. If you're investing in the target date funds or most investments, you want to stay the course. So even when there are downturns, that's a part of being in the stock market. That's a part of being in investments, that hopefully we're in it for the long haul. And that's even for you folks who are close to retirement or even in retirement. We're planning on living another few decades, we hope, right? And then we can pass along these assets long after we're gone, and they could theoretically be invested for a very, very long time. And historically, that market's going to ascend up. Now let's move on to something else that's related to staying the course. And this is called dollar cost averaging. Dollar cost averaging is a disciplined approach that many investors are taking advantage of nowadays, and something that we at URS recommend. Dollar cost averaging is stating that you're going to put in the same dollar amount every single pay period or every month, every year, however you want to divvy it out, instead of trying to just time the market. So we have two different examples here. We have investor A and we have investor B. Let's start off with the red, which is investor A. This investor, during this 5-month scenario, invested in shares that cost $5 every single month, and so they were able to purchase 20 shares totaling $100, but they just purchased 20 shares every single time because the cost was $5. They ended up with 100 total shares, and the total value of their portfolio was $500. Now, investor B, there's a little up and down there, right? Which is more normal as far as what happens in stocks, investments, bonds, right? There's some volatility. But this person decided, I'm going to use $100 every single month and purchase however many shares I possibly can with my $100. So in the first month, it was $5, so they purchased 20 shares. The second month, you can see that the price went down to $3 per share. So what does that mean? Well, the investment went down. So the investment was losing money. Instead of being afraid to invest, our investor B stayed disciplined. They decided to put another $100 in, and they ended up being able to purchase 33.3 shares because the market was, quote unquote, it was on sale, right? They bought their shares at a very low price. The next month it was back up, so the value was going up from there, and it cost $5 per share, so they were able to purchase 20 shares. The following month, the market continued to ascend upward. So now the price was at $7 per share. They continued to put in their $100, and so that came out to 14.3 shares. And then the market came back down $5 a share finally in our 5th month, and they purchased 20 more shares. So investor B, over that 5-month period, because they did some dollar cost averaging, they ended up with a total share amount of 107.6 with a total value of $538. I don't know about you, but I'd like to be person B. Now, how do they get to that point? Well, they did not try to time the market. They didn't say, you know what, I'm going to throw in $100 this month, but in the second month when it's down, I don't trust it. I'm going to only put in, $50. They were consistent. They stayed the course. They stayed with it. And as they had their $100 go in every month, in the end, they won. They ended up with more shares with more value. So we want to stay the course. We want to be consistent with our contributions. We don't want to try to time the market because that is extremely difficult, if not near impossible. Okay? Even for many professionals who are paid a lot of money to try to time the market and do things, they may or may not have a good year here or there, but they're also going to have those bad years that ended up wiping out all those good years. Now let's talk about fees for a moment. In our brochures that Mike has pulled up here for us, we have our savings plan, transfer to URS form, and then our actual investment options 2017 booklet. And I have one of those booklets sitting right here in front of me. And something that I love to look at this booklet, the annual fees of Utah retirement systems. You would be amazed at how low the fees are here at URS. We are a nonprofit trust. An advisor like myself and my colleague Mike here, we do not charge any commissions for meeting with you, having you move your money in or out of URS. Therefore, we have very low fees here at URS, which I just think is fantastic. I love taking advantage of putting my money away in investments here at URS because I know that most of that money is going towards my retirement and not some company's bottom line and or another advisor's retirement. Okay? If you looked in our booklet, you'd see that we have the annual fees for each of our core funds as well as our target date funds. And all of our funds for our target date funds run from about 0.35% to 0.38%. And then our core funds run anywhere from 0.19% to 0.58%. We are in a great place as far as our fees, as far as I'm concerned. You may have some knowledge of some outside firms that might charge a little bit more than that, and there might be an advisory fee on top of that. So let's segue into the dangers of fees, because fees are a part of investing. It's going to be difficult to find a place that doesn't have fees. Why? People need to be paid for their work, right? So if you're investing money somewhere, that company and or that advisor are making money off of your investment. So let's go through this example here in our chart. This individual is saving 7% from age 25 to 60. Their starting salary was $30,000. They enjoyed 2% annual increases or raises, and there is 3% inflation in the economy. First, let's see here. Our first bar graph had a fee of 0.50%, so a half of 1%. Over time, over that 35-year career, they accrued a balance of $353,000 and paid fees of about $41,000. Let's compare that to the bar graph right next to it. This person had 1% fees. The total accumulation came out to $317,000. They paid a total of fees $77,000. Finally, let's get into the 1.5% fee. And this is the stuff that we see a lot in statements, folks. We see a company charging maybe close to 1%, somewhere around there, and then maybe another advisor charging another percent on top of that. So if you have 1.5% as your fee, over time, over this example, this person accumulated $285,000, but had to pay out fees totaling over $108,000. Now, which person do you want to be? I want to be person A. I don't want to pay a higher fee. Fees over a long time can reduce the amount of compounding growth and can really damage your portfolio. So we want to make sure that you're very cognizant of the fees that are being charged to your accounts. Again, at Utah Retirement Systems, you're in a great place. Enjoy the low fees there. So we went through the great ingredients here at Utah Retirement Systems. We have our 8 core investment options that you can choose from. We have our target date funds that you can also invest in, which basically mixes up those 8 core funds, as well as a few others with those real assets. We talked a little bit about our low annual fees. Now I want to talk a little bit about what you can do proactively to make sure that you are in the right investment fund. We have free individual retirement planning sessions. That's where you can sign up to meet with someone like myself, like my colleague Mike, and our other colleagues in our group of retirement planning advisors. And we can sit down for 1 hour, bring your spouse, and we can go through and actually do some projections for you. And we can also go in and give you some recommendations on what we see fit for your investments, which savings plan to choose from, which actual investment to be invested in. So please take advantage of those meetings. I'm going to show you right here on our website how to actually do that. So hopefully many of us have logged on to URS before and created a login. maybe played around with a few of our great tools. We have our calculator tab there. We have some other publications there that you can take advantage of and read. But that's what the website looks like. Once you actually go in and log into your account, we have a few items within your login that you can take advantage of as well. First off, let's take a look at this piece called the Investor Profile Questionnaire. And in order to find this little location, you log in, you click on that Education tab, and then one of those tabs in the middle on the left side says Investor Profile. And this is a very brief 9-question questionnaire. It's going to help you determine how you feel about risk. And it's also going to give you a recommendation on which target date fund might be most appropriate for you based on you answering these questions and also understanding how old you are or where you're at in your career. So I'd highly advise you go out to our website, log in, take this questionnaire to have a better idea of what you are as far as risk tolerance so you can create a better mix for your investment salsa. Now you can also change your investments here. When you log in, you click on your savings accounts. And so for example, we chose the Roth IRA here. So we clicked on the Roth IRA and we open it up and it's going to show us a few tabs here and it's going to show us where we're investing currently. Now there's two things that you can do here to either change or update your investment salsa. The one we have highlighted here is called the investment of future contributions. This is where you can change where all the future contributions are going to be invested at URS. That's for your employer contributions and your investments as well if you want to contribute, which we hope you are. So if you wanted to change the future contributions, you would click on this tab. You would pick which core fund or target date fund that you would like to invest in, and you can put the percentage of your money that you'd like to be invested there. If you have a balance that's sitting there already, which is very common, you can move those funds into a target date fund, for example, if you'd like, by choosing the fund transfer tab, which is about 3 clicks above that investment of future contribution tab. You click on that fund transfer tab, and that will enable you to actually move your funds from the current investments into the new funds of where you'd like it to be invested moving forward. Okay, here's a nice little picture of pull up a chair. This is exactly what I was mentioning about our individual retirement planning meetings. We hold these meetings every single day, Monday through Friday, at our Salt Lake City headquarters. And we also have these meetings periodically throughout our territories throughout the state of Utah. And so you are more than welcome to sign up for any of these meetings wherever they're held, even if it's not at your employer. You just need to be able to go online, click on our education tab, and you'll be able to view our dates, locations, times. And once you sign up, we'll give you a few things to do as far as what to bring and what knowledge to have coming to those meetings. We would love to see you once before you retire. We'd love to see you multiple times throughout your career because we want to help you set up a plan and then help you follow that plan and maybe even readjust that plan as you age in your career. Finally, once again, it's National Retirement Security Week. We're so happy that you could join us today for Investment Salsa. I hope that you have a better idea as far as your core investment options and your target date funds are. Please contact us anytime and meet us one-on-one. We can help you make your own investment salsa. I'm Mikey. Thanks for taking time with me. Have a great rest of your day. I'm going to hand it back over to.
All right, thanks, Michael. We really appreciate that. Appreciate your willingness to do this again. Remember, if you're watching this, that if you have additional questions, you're interested in finding out more information about making investments also, or actually anything related to your retirement benefits, we invite you to visit urs.org. We have videos, publications, webinars, seminars, one-on-one sessions. We do presentations at agencies. We're pretty much all over the place, but reach out to us. Let us help you out. We do encourage you to take advantage of all of these resources so that you can make the most of your retirement benefits. Thanks again for listening and have a great day.